Today was another really volatile day in the stock market, with the S&P 500 falling 2.78% and closing at 3331.84. Thank you for watching this video. My name is Rodney Constable. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the president and founder of Simple Market Signals at simplemarketsignals.com. Today we will be doing technical analysis on the S&P 500 for Tuesday, September 8th, 2020. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. Just today, we were down 2.78% on the S&P 500. This first chart is a 1 minute, 1 day candlestick chart of the S&P 500. So this is just today's price action, guys. I mean, this was super volatile, as we can see, and we closed right at the lows of the session. So not a good day in the stock market again. And this is in addition to the losses we experienced on Thursday and Friday of last week. This next chart is a 2-day, 2-minute candlestick chart of the S&P 500. The reason this is important is this is Friday's price action, and we can see that we came down to this first blue line that I've annotated here right at 33.50. So based on Friday's price action, 33.50 was acting as an area of support, and we bounced off of that. You can see we came exactly down to that level and then bounced off of that. And then today, you can see this dotted blue line. This is where we closed on Friday. We gapped down at the open, and then we came down earlier today and hit this 33.40 level. Up until 2 o'clock, the 33.40 level had held, but you can see just after 2 o'clock, we started to sell off and broke beneath that level, bounced above it, and then played around and got up to this 33.50 level and got rejected and closed right at the lows of the session, closing at 3331.84. The next chart that we're going to look at here is a 5-day, 5-minute candlestick chart of the S&P 500. And I wanted you to see this because on Wednesday, the 2nd of September, we hit an all-time daily closing high on the S&P 500 at 3580.84, where we closed right there. And then you can see here that on Thursday and Friday we sold off. Of course, Monday was a holiday for Labor Day. This is Tuesday's price action. So you can see how volatile the markets have been over the last 3 days after hitting an all-time high on the S&P 500. The next chart that we're going to look at here is a 1-year daily chart of the S&P 500. So on this chart, each candlestick represents 1 day of trading. And you can see here the all-time high that we hit back on Wednesday, September 2nd, and then the sell-off on Thursday, Friday, and then, of course, today on Tuesday. And the first blue line here illustrates the 33.50 support area. There is some support around this, and with support areas, plus or minus 25 or so points, kind of gives you a range. But if this area, this 33.25 to 33.50 level doesn't hold, then we will probably fall to at least the 3,200 level, if not the 3,000 level on the S&P 500. Around 3,000, there is quite a bit of support going clear back at least a year or so. So if the 3,200 level doesn't hold, then we'll fall to 3,000. But of course, the first thing we need to keep our eye on is whether this, this 33.25 to 33.50 level, is there enough trading in this level to provide support? Given the fact that we've already sold off quite a bit over the last 3 days, guys, I don't know. I mean, we are in the worst 3 months of the year. September tends to be the worst month of the year, but remember, August, September, October collectively tend to be the worst 3 months of the year. We're just a couple of months out from a presidential election. That adds volatility. Market valuations are very, very lofty on, whether you're looking at price to sales ratios, price to earnings ratios. There's a lot of risk in this market. So don't get overly confident and too complacent here, guys, because even though we've sold off, a little bit here over these last 3 days, there's still a lot of froth left in these markets. The next chart that we're looking at is a 1-year daily candlestick chart of the S&P 500. So a very similar chart. On this chart, though, we have the 200-day moving average and we have the trend line that I drew underneath the trend that we had in place starting back at the end of June. And you can see here we came down and touched this trend line several times on the way up. We broke it on Friday and then, of course, sold off further today. So you can see even though we've sold off, we are still a ways above the 200-day moving average on the S&P 500, and we have convincingly now broken this uptrend to the downside. So that is not good. That uptrend had been intact for about 10 weeks. Only time will tell, what the price action is on the market over the next few days or few weeks, but the odds are not in our favor in the short term here. So this next chart is the same one-year daily candlestick chart that we've been looking at, except I've dropped the trend line and added the 50-day moving average. A couple of things that I wanted to point out on this chart is that even though we've sold off pretty hard over the last 3 days, we are still above the 50-day moving average. So it just shows you how far extended above the 50-day moving average we were. And look at the gap we still have between where we're at and the 200-day moving average. So further downside in these markets is definitely possible over the next few days or a few weeks here, guys, because it's not uncommon that when you start to get a correction that you pull down to the 200-day moving average. That's actually, or at least towards it. Right here, we didn't quite make it back in October of 2019. But you can see that the pullback to at least the 50-day moving average is very common, but oftentimes you pull back to the 200-day moving average. So further downside here over the next few days or few weeks is definitely possible. Only time will tell, what the markets bring us. But right now, the momentum is definitely not in our favor. The other thing I wanted to point out here is that the sell-off over the last few days has been on much higher volume. You can see here that the sell-off that we had on Thursday and Friday of last week was definitely on much higher volume than what we had seen for the previous few weeks. The next chart that we're going to look at is for the DIA. The DIA is the ETF that tracks the Dow Jones Industrial Average. For those of you that like to track the Dow, we were off 2.25% today on the DIA. You can see that the DIA is still trading well above its 50-day moving average, even though it's sold off for the last 3 days. And, of course, it's well extended, still above its 200-day moving average. So further downside in the Dow as well as the S&P 500 is definitely possible. And you can see here that the sell-off on the DIA over the last few days has definitely come on higher volume than what we had seen for a couple of months. And then when we move over to the triple Qs, the NASDAQ 100, we can see that this one has really sold off hard over the last few days. Just today alone, the triple Qs were off 4.81%, and the triple Qs closed right at their 50-day moving average. But you can see the gap here that we have between where we're at right now on the 50-day moving average and where the 200-day moving average is for the triple Qs. So further downside again is really possible, and of course the triple Qs were really extended above their long-term moving average, and a lot of the stocks in the triple Qs were really overbought, and you can see huge volume here coming out of the triple Q on this sell-off over the last few days. Before we go any further, let me ask you a question. Do you have a stock market risk management system? Something that helps you understand the various risk levels in the stock market on an ongoing basis? Do you know when it's safest to be in equities? Do you know when it's most dangerous to be in equities? Do you know the direction of the short-term trend on an ongoing basis? Do you know the direction of the overall trend in the stock market? My system is called Simple Market Signals. Simple Market Signals is market-based. There's no opinions, forecasts, or guesswork in Simple Market Signals. It took me over 20 years to develop Simple Market Signals. I developed Simple Market Signals by reverse engineering the stock market, and I studied the stock market over numerous time frames, including in numerous bull and bear markets. And what I found is that certain conditions exist during these various market phases. And then based on that information, I created simple, easy to understand signals around these different phases of the market. And the thing is that most people don't know about or have access to the data necessary to do the research that I had to do to put together this model. Now let's take a look at the signals. The red signal has the highest equity risk associated with it, and the worst sell-offs, including bear markets, will happen when the signal is red. When the signal is yellow, this means that equity risk is moderate, and sideways to slightly up or down price action is very common during a yellow signal environment. The green signal is the best signal. It has the lowest equity risk associated with it, and most all upward progress in the stock market will be made in a green signal environment. Said another way, it is very hard to make money in equities unless the signal is green. Okay, a quick refresher on the Simple Market Signals weekly signals and how they can help you. The signals are green, yellow, and red. The green signal is the best risk-reward ratio for equity investors, and what you're going to find is that the stock market makes most of its upward progress when the signal is green, okay? The worst risk-reward ratio signal for equity investors is when the signal is red, and what you're going to find is that bear markets and the worst downturns in the stock market happen when the signal is red, like during the 07 through 09 bear market, as we see here. So again, the best risk-reward ratio signal for equity investors is when the signal is green, and the worst risk-reward signal for equity investors is when the signal is red. Now let's take a look at the first 3 months of 2020 so you can see how Simple Market Signals could have helped you in the most recent downturn. We know that we came into the year with a strong stock market, so we had a green signal for the majority of January, but on January 27th, the signal went yellow for a couple of weeks. We went back to green in the first part of February, and then we know that we hit the all-time high on February 19th at 3386.15. That is the closing high so far on the S&P 500. And then we had this intraday reversal on Thursday, which I talked about in my Simple Market Signals newsletter, which of course is how I disseminate the signals. And then we closed lower on Friday again. And so what we can see here is, and I warned my newsletter subscribers on Saturday, the 22nd of February, that I felt like the market was starting to roll over, and that that things were changing. And so I gave people a heads up right here over the weekend, and I told them that if the market continued to sell off, that we would probably see at least a yellow signal, if not worse, the following week. And that's exactly what happened. On the 24th, the Simple Market Signals risk signal went yellow. Now, one of the other things that I want to point out here is, in addition to the risk signal, I also have several trend direction indicators in this Simple Market Signals model. Now, the longer term one is called the general trend indicator, and the general trend indicator went negative on the 25th. So on the 24th, the signal went yellow. The general trend indicator went negative on the 25th, and then 2 days later, the signal went red. The risk signal went red. So think about this. All in 1 week, just a few days apart, we had a yellow signal, we had the general trend indicator went negative, and then we had the risk signal went red on the 27th. That was Thursday, all right? And by the way, this general trend indicator is a positive negative signal, okay? And it operates totally independently of the risk signals. It's just trend. So the general trend indicator gives you still another way to monitor and control risk in your portfolio. And guys, that general trend indicator had been positive since October, all right? So that thing had been positive for, 5-6 months, and then went negative. So right there, just those two signals alone told us that something was changing in the stock market. And then by the 27th, the signal had went red, and we can see here that the market fell from there. As part of the Simple Market Signals model, there are 3 powerful indicators. There's the Simple Market Signals proprietary risk level signal. There's the short-term trend indicator, which helps clarify short-term moves in the overall U.S. stock market. And a normal signal length for the short-term trend indicator is anywhere from 1 or 2 days to 7+ weeks. Then there's the general trend indicator, which is designed to stay positive during the bulk of most uptrends and negative during the bulk of most downtrends. And a normal signal length for the general trend indicator is anywhere from 2 weeks to 5+ months. We disseminate the information through the Simple Market Signals weekly newsletter. In the weekly newsletter, you will receive the proprietary risk level signal on the overall U.S. stock market. You will also receive the proprietary risk level signal on all 11 major sectors of the S&P 500. You will also receive the short-term trend indicator signal. You will also receive the general trend indicator signal. You will also receive market and sector performance information over multiple time frames. You will receive a recap of what happened in the stock market for the past week. You'll also receive technical analysis information, fundamental analysis information, and yield curve information. There is a ton of information every week in the Simple Market Signals newsletter. And a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents per day. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. And guys, I want to set realistic expectations here, okay? The newsletter isn't fancy. It's effective. It's plain text, no color, no fluff. And please note that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, that is just due to international compliance regulations. Now let's recap what you will get with your Simple Market Signals subscription. You will get the weekly emailed newsletter with all of the contents we just talked about. You will also receive special midweek updates when warranted. So if there's a major signal or direction change in the middle of the week, we're not going to wait until the weekend to get you that information. We're going to get that information to you as soon as possible via a special midweek update email. The best fit for a Simple Market Signals subscriber is an investor or trader with at least a 6 to 8 week plus time frame that they're focusing on. If you're a day trader or a really short-term trader, Simple Market Signals may help you a little bit, but the reality is Simple Market Signals is designed for those investors and traders with at least a 6 to 8 week plus time frame that they're focusing on. And if you would like even more information about how you can benefit from Simple Market Signals, I have the following videos that will be linked in the description box below this video. And to subscribe to Simple Market Signals, you just need to go to the website that you see on the screen here. That's https://simplemarketsignals.com. It'll take you about 4 minutes to subscribe. It's that easy.